Unit 2, the Regulatory and Conceptual Framework of Accounting. Section 5, Accounting Concepts and Conventions. 1. By the end of this session, you should be able to define accounting concepts, accounting bases, and accounting policies. Discuss the usefulness of accounting concepts and describe the fundamental accounting concepts. Accounting concepts and conventions are the set of rules, principles, postulates, conventions, and methods applied in the measuring and recording of business transactions and reporting financial information. Accounting bases are the methods used for applying fundamental accounting concepts to financial transactions and events when preparing and presenting financial statements. For example, methods of depreciation. Accounting policies. They are the accounting bases adapted and consistently followed by an organization in the preparation of financial statements. For example, the adoption of the straight line method of depreciation. Usefulness of accounting concepts. Accounting concept ensures standardization. This means that the same standards or concepts adopted are used in the same way for the preparation of financial statements. It also ensures consistency, which means that when an accounting concept is adopted, it is used consistently unless there is something which will lead to its change, and the factors that has led to the change of the use of the accounting concept should be explained why there is a deviation or a change in accounting concept. Other than that, it is expected that the concept will be used consistently. Accounting concept also ensures comparability. When two entities or between two periods we use the same accounting concept, it becomes easier to compare the periods and make decisions from that, as compared to applying different concepts to two different periods or two entities and making comparison becomes difficult to make such a comparison. Fundamental accounting concepts. We have the going concern, prudence or conservatism, accrual or matching, and consistency. The going concern or continuity concept. The going concern concept assumes that an enterprise will continue in operational existence for the foreseeable future or for an indefinitely long period of time, and there is no intention to put the company into liquidation or make a drastic cut back to the scale of operations. The main significance of the going concern concept is that the asset of the business should not be valued at their breakup value, which is the amount that they will sell for if they were sold off piecemeal and the business were thus put to an end. This convention is seen as providing support for the historical cost convention, as it's argued that estimate of current value only become relevant in the event that the business intends to cease trading and sell its assets. Examples of the usage of the going concern or continuity concepts. Prepayments, depreciation provisions may be carried forward in the expectation of proper matching against the revenues of future periods. Property, plant, and equipment are recorded at historical cost and depreciated over its useful life. Prudence or conservatism concepts. This convention requires that losses, whether actual or anticipated, should be recognized and accounted for, whereas profit should only be recognized when realized. The concept supports the historical cost and the realization conventions and ensures that where alternative procedures or valuations exist, the one selected should be that which would tend to understate rather than overstate profit. Revenues and profits are not anticipated, only realized profits with reasonable certainty are recognized in the statement of profit or loss and other comprehensive income. However, provision is made for all known expenses and losses, whether the amount is known for certain or just an estimation. This treatment minimizes the reported profit and the valuation of assets. Examples of the usage of prudence concept include Property, plant and equipment values are at cost rather than current market value in the statement of financial position. Property, plant and equipment must be depreciated over their useful economic lives. Inventory valuation sticks to the rule of the lower of cost and net realizable value. The provision for doubtful debt should be made. Profit on unsold inventory is not anticipated, and credit taken of the desired profit in the current period, but deferred to the year of sales when the sales revenue will be realized. The accrual or matching concept. Revenues are recognized when they are earned and not when cash is received, and expenses are recognized as they are incurred but not when cash is paid. The net income for the period is determined by subtracting expenses incurred from revenues earned, that is, matching the expenses to the revenues for the period. Examples of the accrual concept includes expenses incurred but not yet paid in the current period should be treated as accrual or accrued expenses under current liabilities. Expenses incurred in the following period but paid for in advance should be treated as prepayment expenses under current assets. Depreciation should be charged as part of the cost of property, plant and equipment consumed during the period of use. The consistency concepts. Companies should choose the most suitable accounting methods and treatments and consistently apply them in every period. Similar transactions should be treated in a similar manner during the accounting period. The accounting policies for the treatment of items should be consistent from period to period. Changes are permitted only when the new method is considered better and can reflect the true and fair view of the financial position of the company. The change and its effect on profit should be disclosed in the financial statement. Consistency allows for a more valid and meaningful comparison of figures to be made from one period to the next. Examples of the application of consistency concept includes if a company adopts straight line method, it should not be changed to adopt reducing balance method in other periods. If a company adopts weighted average method as stock valuation, it should not be changed to other methods such as the first in, first out method. In this session, we discussed accounting concepts, accounting basis, and accounting policies, the usefulness of accounting concept, and the fundamental accounting concept. Thank you.